Good morning, traders. Steve Gans here, and I've got a new concept trade I want to share with people. So, probably one of the most common questions I get asked is, how do you hedge against a black swan event? In other words, if you've got an IRA or some sort of account that you've built up equity in over the years, you've got some stock in that, it's reached a certain size, and you want to protect it against again, I'm stressing this trade is for a black swan event, and we'll see why. Now, what is a black swan event? Well, black swan is not a 5%, 10%, even 15% pullback in the market. A black swan event is a once in a 3-decade, 5-decade sort of thing. And some current examples would be COVID. That's where our markets dropped 40% in some cases. The 2008, 2009 era market would categorize into that, where we had drops of as much as 50%. You could also go all the way back. I traded through the dot-com bubble burst in 2000, where our markets, the NASDAQ specifically, dropped by more than 50%. So those are what I'm calling black swan events. Now, another thing that characterizes a black swan event is it usually happens pretty darn fast. I think if you think back in all three of those cases, the sell-offs happened fairly rapidly. There's a saying in the market that the market takes the escalator up or the stairs up and the elevator down. So our markets often climb somewhat slowly, not the past couple of years, but when they do fall, they tend to fall a lot faster than they climb. Now, that spikes volatility in the market, which becomes very, very critical in this trade. I'm going to walk you through exactly how this trade is constructed here in a minute. In fact, I'll bring that down right now. So this Black Swan hedge consists of, and I'm doing this in the futures. That's the most common way of doing this. And I do it in the futures because futures are leveraged. So that means that it doesn't eat up nearly as much buying power as it might eat up if it was in a different product, such as SPX, etc. Again, one of the beauties here is you can model this in option strat and kind of see what your max loss or max risk is. In most cases, that's going to be the amount that your broker will set aside for this. Now, keep in mind, this particular example that I'm sharing is done in the ES product, the regular S&P futures. If I had a smaller account, if I needed to hedge a smaller account, want smaller risk, I could do this in the MES, which is the mini ES futures. And they are a fraction. I don't trade those. They're a fraction, I believe, 10% of the value of the full-sized futures contracts. Okay, so now let's take a look at this trade and see how it's constructed. So the first thing we're doing, again, I've gone out here approximately 50 to 75 days. I am selling a 30 delta put. So if we take a look at our deltas here, this one happens to land right on 30. It may not. It could be, a point or two either side. So I'm selling 130 delta put, and then I am buying a roughly 10 delta put, and I'm creating this put spread. Now, if the market just continues higher here, I'm going to be $2,000 profitable. If the market were to sell off, I've got massive potential loss here. But again, my concern, what I'm working for here is a black swan hedge. Remember, that is a significant sell-off. So what do I want to do now? I want to come here and I want to buy approximately 1 delta long puts, and I'm going to buy 10 of them. Okay, so let me include this now in this diagram. Once I include those in the diagram, we can see here that in a big market sell-off, again, we're talking 30, 40%, a black swan event. Let's just say that our market drops from approximately the 6,000 mark down to the 4,000 mark. This trade, if volatility didn't change at all, this trade would be up about $120,000. Now, what kills this trade, what's a problem for this trade, is falling into this valley of death here. As time marches on, if our market were to just slowly drift back, this trade could have significant potential loss. Not obviously what we're after, but also not what we're trying to insure against. The way I look at this in the terms of insurance is you insure your house and you can choose a deductible on your house. Well, this valley of death is kind of your deductible. In other words, if I have a claim, water damage, and I've got a $50,000 deductible and the water damage is $40,000, well, I'm not insured in this particular case. However, if I've got that insurance and the house burns down and it's a full rebuild, a $400,000 event or $500,000 event, well, I've got major insurance for that. So that's maybe a way that to kind of help people understand this. So again, what I'm insuring for is that black swan event or that major event. Now, one other thing we need to look at here, not only the fact that this could drift into this area, let me take this back to today and before there's any real decay into it. And I want to look specifically at what happens if implied volatility spikes. So let's just say there's some sort of a significant global event and our markets tank and volatility goes up. Now, volatility goes up a lot in those scenarios. So let's just say that, volatility doubles, which is not out of the question. So volatility doubles, you can see that because the value that these long puts will instantly gain as fear comes in, as traders are rushing out to buy puts, buy that insurance at any price, they'll pay up for it. Look what that does to this P&L line. There is never a point, at least early on, where this thing goes into the negative. And even most of the way through this trade, even as we get 33 days into the trade, we still have a big, with volatility increasing, we're still what I would call okay on most any sort of a pullback. So early on in this trade, if there's a 10, a 15% pullback with a spike in volatility, this valley of death usually does not exist. And I say usually because there's no guarantees in this. We're just looking at, when our market sells off, fear and volatility historically tend to spike. Now they can spike by different amounts. Maybe it doubles, maybe it doesn't double, maybe it triples. So that's why we can model these different scenarios, but you never really know for certain the extent that volatility is going to spike or where that's going to happen. Still got a little bit of COVID lung here. Where exactly that's going to happen in our timeline. So the closer we get to expiration, the more we can fall into a valley of death. So for that reason, this short leg is usually closed at about 20 days to expiration. At that point, a vast majority of the theta decay will have happened in this. So we're selling this right now. It's got an extensive amount of extrinsic value in it. In this case, the $74 or so. And that's virtually all going to drip out of this thing as we get closer to expiration. So when we get about 21 days from expiration, usually I try to remove this one at a favorable price. And if I exclude that, and of course that's going to be at a profit when I exclude it, now all of a sudden I have a lot more ramp to the downside. Now, this is showing the $3,600 loss here, but keep in mind, I just excluded this. I did not show closing it. If I were to have closed this as we get to about 21 days, again, I would have taken in about $75. I'd probably be able to close it for maybe $20 or so, giving me about $5,000 in profit there. And again, this is showing $3,600 in loss. That's because just excluding this and not closing it is not actually showing that profit. So let me just include this again. So that's the general complexion of this hedge. Again, I want to stress to people that you have to decide in your account how much of your account you want to hedge, first of all. But the key is that if our market stays the same or goes up in value, there's no cost essentially to this hedge. If we fully tank and volatility spikes when some sort of 1,000-point down move, 2,000, 3,000-point down move happens, when that volatility spikes, there's no risk of falling into that valley of death. The times that this trade will challenge you is if you get out close to expiration, you get out here just, maybe somewhere in this general range, you haven't shut down this short leg yet, and then you get a drift, a slow drift or grind back into this valley of death without a spike in volatility. That can be challenging on this trade. So again, we have to understand what we're protecting against and how we're paying for it. And this is how we're paying for it, is the fact that we do have this valley of death risk, particularly as we get closer to the end of the trade. So that's why, again, the goal is to close this short leg, maybe in the 21-day out or so range. So hopefully that makes a little bit of sense. This is one of the many ways that people can potentially do a black swan hedge. And again, many people that do this do tend to do it in the futures. And obviously, OptionStrat has the ability to model futures, which is a relatively new feature here earlier this year, in case you were not aware of it. So thank you, everyone, for taking a look at this black swan hedge trade with me and walking through the steps of how to set one up. So I'd like to ask a favor of you. If you like this type of content, if you find this of value, please give me a thumbs up, like and subscribe, and also always feel free to give me any comments on the types of things that you would like to see going forward. Thanks so much.